Yeah, this is a company we've been following both on the podcast. I think we've done a couple of segments, or Brendan's done a couple of segments on it before. As well, we've talked to them in person. I once before with me, and I think you guys had prior as well before that. So RE Royalties, symbol RE on the TSX Venture. It's a renewable energy generation facilities royalty and loan provider through non-dilutive royalty financial solution to privately held and publicly tradable renewable energy generation development companies. Effectively, they lend money in various manners to help at renewable energy production. The company's portfolio is comprised of solar storage, wind, hydro, and biogas, and its assets are located, or the underlying loans are located in Canada, the US, Mexico, and Chile. The company is a strong dividend payer, at least as far as the yield goes, at this time at 8.2%. The stock, however, has been trading flat over the year to date so far at 49 cents. It's actually 0% at the time of recording. But however, if we zoom out a bit, it's fallen about to a third of the price it was seeing in late 2020 and early 2021 of $1.50, and now we're at the 49 cents. So it's fallen quite a bit. Part of that you can just directly attribute to interest rates have increased, which makes these dividend royalty payers less attractive. But as well, we are looking into the company a bit more. So let's look to see if the company really supports the current price, or if there's more room to grow, or if it's going to fall a bit more. So as RE Royalties is a financing company, it's really important to look at how the investments are structured. The company invests in both pre-operational and operational assets, so things that are in construction or that are already operating and producing some sort of revenue or producing something. The pre-operational matters particularly for revenue output-based royalties, as the company is not receiving the payments from those royalties during that initial period, as there really is no output. You can't have a power-producing royalty that's producing no power give you a royalty that's based on power production. The company does, however, do a mix of royalty financing and loans for the majority of their deals. The difference is royalties will be based on some sort of output, whether it be revenue or dollar per watt. If you look at something like oil, gas outside of RE space, it might be they get, for every 100 barrels, they get the rights to 2 of those barrels, something like that. Whereas loans will be independent really of that output, normally being a fixed or variable interest rate over time, with a potential repayment of the principal at the end, or that principal could be mixed into the payments as they go. Effectively, there's a bunch of ways you can structure this, but royalties really are based on output, versus loans it's more of a traditional financing option. If you think of a mortgage, that'd be more like the loans in these cases, versus royalty, that's completely different. As well, there is their mix of royalties and loans, and that really matters for RE Royalties because it comes into their finances. So really the reason why I bring this up is 90% of their revenue and finance income that RE receives is classified as finance income. So that's income from loans. 2.4 of the 2.6 in the last quarter is classified as loan income. So that's only 200,000 not being that royalty income. So when your name is royalty, but only 200,000 is being classified as royalty, you really need to look in why that's occurring. The company has been structuring most of its deals as royalties, as a part being royalty, but it really needs to come online over time if the once the loan term matures and then the assets continue to perform. So if we look at the last quarter, for example, they closed out 3 deals with royalty or partially royalty structures, and as well as loans embedded in the same deal. So this is where what I mean is you need to look at, is it a loan, is it a royalty, or what the mix is. So going through the 3 deals, Clean Communities Corporation is a 4 megawatt solar construction project in Alberta, which is comprised of a $1.7 million loan over 5 years, and then after that a 5% 20-year royalty payment afterwards. Revolve Renewable Power Corp, a 23 megawatt hydro and wind in BC and Alberta. Once again, we see this hybrid royalty loan structure with a $4 million, a 36-month loan. Then during that time, they have a 0.5% royalty, but then after the loan, it goes up to 1% after that loan repayment. Then the last addition during the quarter was Revolve DG, a $415,000 loan for rooftop solar for a Mexican food manufacturing business, with once again a royalty on top of once the loan's repaid. They get 5% of the revenue received from this operation for 15 years. So as you can see, despite its name, they're largely involved in loans as well, in effectively every deal they make. When we talked to the CEO, I think it was last October, he said 80% of their deals were this hybrid. So I would likely think that it's even increased since that, as all the deals that they are bringing on are this hybrid structure. So now we can really look at the last quarter to understand why the majority of its top line is generated from the finance income, despite the company's name. It does have royalties that will come online in the future. We do see those construction projects or ones that they get the royalty after the loan is repaid. So that can be 3 or 5 years down the line. And I will add, the CEO did say he personally believes that more of their revenue should be classified as royalty, but the accountants disagree. And that's why you see this. But when we look into it, we do see that hybrid situation, and it really comes down to how you want to interpret it. If you do count more of that as income or finance income or loan income versus royalty payment, because it is structured in the future as a royalty. But at this time, we can really see how the accountants treat it, and it is firmly in the position of they're treating it as loan income at this time. But despite that, the company did have a nice overall increasing of the overall financing income to 2.6 million from the prior year's 1.8. So that's a strong increase in what they're receiving in between the revenue and the income. Moving down the income statement, the company does, however, have a significant financial expense as it uses green bonds to finance its investments. Green bonds are like a normal bond, but they're limited to certain types of investments in the green space uses. But they also offer, since they are restricted, they're given a lower interest rate, so the company does benefit from it. And particularly RE Royalty, I will say they do benefit greatly from this because they're not really going to invest outside of the green space, so they're able to reap the rewards from the green or the green rate. So it might be a few percent lower, while still just investing in green projects, which they would have otherwise. But overall, the company did have finance expense of 0.9 million with outstanding green bonds of 36.6 million. So that's their significant debt on the balance sheet. Ultimately, the company ends up with a net income of 659,000 or 1 cent per share. We've seen the trend of the EPS flip between the range of net income of 1 cent per share to lost net income per share for the past couple of years. And there's not really any consistent trend on the bottom line. But like I said before, we do see that actually the top line is growing pretty consistently over time, with the exception of a royalty buyout last year. We're not going to count that, normalizing that out. However, we move to the dividend. 8.2%, great yield, but it doesn't have a huge margin of safety in its current form, as the EPS and cash flow either barely support the payment of the dividends each quarter, or after the green bond interest payments, it is most of the time a deficit of payment. So this really reduces the sustainability over the long term of a dividend when you are not able to generate the cash or the income to cover the dividend over time. But the company does have a nice cash on its balance sheet, not a net cash position, but just cash on its balance sheet of 14.6 million. So if you want to just pay out the cash over time, you can do that for a short term. But once you're looking at the long term, 3, 5, 10 years, this is when dividend payers do get in trouble because they're just relying on the cash balance sheet, which will, of course, slowly come down over time. So they really need either growth to support this dividend, or they would need to reduce the dividend, which is why you don't have that massive margin of safety. When you're looking at these other companies, you might only want 20, 50% of the payout. And of course, but being a royalty company, that's normally higher. 80, 90% isn't unusual. Even 100% isn't unusual for these royalty companies. But if you want any sort of growth, it needs to be lower because it's either growth or repayments, one of the two. And right now, there's no really room for growth in its current structure. So concluding, the company is growing its financing and royalty base quite consistently, which is a positive. However, the dividend interest payments do not really leave room for growth through internal cash flows. So what I mean by that is they aren't able to reinvest their internal cash flows that they're receiving from their royalty and financing income into new operations. They need to either refinance, they need to sell off the royalty, collect on the loan before they can really put it back in. But they're not really getting anything additional once you're subtracting the dividend and the interest payments. If the company really is able to get to the point where royalties do come online and start to provide a significant portion of that revenue in the next 3 or 5 years, likely, just given the structure of how they are doing these deals, they could have internal cash flow, which then they can feed into more deals and so on. And that this is a recursive cycle, and you really get that exponential growth. That's that inflection point which you want to look for in these types of business. But for now, it really just has a ways to go, and that's why we want to monitor for that type of inflection point and see if it can get there for the time being.
Yeah, I think it's a good point at the end. We are looking for that inflection point, kind of when these hybrid loan/royalty agreements can start to compound up down the road where it's getting paid more in royalties. I think that's what you would be looking for, Brett, where it would have a larger degree or percentage of the revenue actually coming in from those royalties as they mount over time. That may happen in this company, and there may be an opportunity at some point. We continue to monitor it. It may not happen, right? So we'll continue to monitor that going forward. Is that what you'd be looking for, Brett?
Oh yeah, that's definitely what I would personally be looking for. I want to see that inflection point, because then it really changes the risk reward dynamic. You'll have similar risk, but the reward goes vastly up once you see that, and that's always what we are wanting to look for, is that risk reward trade off. You don't want to be overtaking the risk.
Yeah, and like
we're monitoring for.
Of course, like we said many times in the past, we've looked at companies for years before we actually make a recommendation, particularly in the small cap sector, where you're watching a company evolve over time, watching management to see if they're making what you would say would be smart capital allocation moves. And you know, again, there are times when you watch a company for 5 years, don't invest in it ever. You know, we had a company this fall that we interviewed management 4 to 5 years. They were sick of us, I'm sure. I'm kidding. But, you know, you go to the same events and they say, so when are you going to recommend? And we're looking for that inflection point. And if it hits, it can be really powerful for an investor. And, you know, the VitalHub was that company this fall in November that, you know, hit that point where it was producing 10 to 12 million in cash flow on an annual basis, and we could buy it at under 10 times free cash flow. And that's free cash flow that I'm talking about for a software company that we expected to grow between 15 and 30%, maybe 10 to 15% organically, then grow with acquisition. And if you see that inflection point where you can buy it at a good price, the market is kind of forgot about the company at times, and then you find that inflection point, then you have a better margin of safety, and you have that kind of blue sky green growth potential. And like that happened with VitalHub. It was 325. It's 750 today. That's 6-7 months later. We would expect that to happen that fast, but it can happen when these companies hit their inflection point. That's why we monitor so many companies, attend so many events, interview these teams, and see if they're pointing in the right direction. We'll continue to monitor RE. Potentially in the future they hit an inflection point, and the market falls asleep on it, and we can buy some at a reasonable price with more safety.
Yeah, and go on, Brett. You go ahead. Oh, okay. You at the same time, when we're talking about these inflection points, is you'll see both the underlying financials improve, so the fundamentals improve, but then the market starts to value them more. So you'll see them go from a 10 times cash flow then to a 20. So not only did their underlying cash flows double, the valuation doubled.
Re-rating.
2 is 4. There you go. And that's how you really get those grand slams.
Yeah, and all I was going to say is just we had spoken with the management team back in October of 2023, and I believe at that time, like I've written in my notes here, about 25% royalty income, 75% interest, and he had mentioned that, going forward, this should be, again, shifting more towards royalty. He gave us some percentages over the years, but again, it's whether they will hit those or not. Again, those are just targets. But yeah.
Yeah, and it's what we continue to monitor on the company going forward. Certainly looks like an attractive yield, but we need that more certainty of the royalties becoming a larger part. I think they're trying to move in that direction.
Yeah.
We'll see if it gets there, compounds over time, where they have so many royalty deals out there that are actually producing solid royalties that it does become. And then it could be that inflection point.